Start with the big data dump of the day, and that was the producer price index for January, and it wasn't good. It wasn't good. It was not good at all. The inflation concern that we all have was actually escalated on Tuesday morning as the producer price index for January came in well above economists' predictions. This according to the Bureau of Labor Statistics. So month over month, the producer price index for final demand jumped 1%, which is up from the 0.4% increase we saw in December. But 1% for a month? I mean, that's 12% annualized rate. That's nuts. So what was the annualized rate? What was the year over year data? 9.7%. Now that was down from December. December was 9.8, but it was actually supposed to drop. Economists had projected that the month-to-month growth would only be 0.5%, so they were off by half. they weren't that close. And then they expected the annualized growth rate would fall to 9.1%. Instead, it only fell 0.1%. So we're still at 9.7%. And producer price matters because this is what companies are paying for products, which they then turn around and sell to us. So as the wholesale prices go up, that usually will get passed on to consumers. Or as some politicians like to say, greed, because they pay more, they make consumers pay more. Well, yeah, that's kind of how that works, right? Isn't that kind of the way our economy works? So like I mentioned, the CPI report, this is coming on the heels of the CPI report that showed that overall inflation hit 7.5% in January. So if anyone's hoping that number is going to fall anytime soon, well, no, because the CPI lags the PPI. So as long as the producer price index remains elevated, no one is projecting that CPI is going to fall. Mahir Rashid, U.S. economist at Oxford Economics, told the Wall Street Journal that it's unlikely to dissipate with continued supply chain problems and high energy prices, telling the Journal, quote, the latest advance in producer prices was driven by another strong gain in goods prices, but increase in service prices continues to broaden. The combination of stubborn supply disruptions and elevated energy prices will prevent producer prices from reverting to more normal patterns until later this year. So this is the data. Things are not looking good. But actually, it looks worse because making matters worse is the complete ignorance that exists in Washington on this issue. And I don't know, should I give them the benefit of the doubt and say, well, it's not actually ignorance. It's more than likely politics. But for some, it's ignorance. I don't know which is more. There's ignorance and then there's politics. And to be honest, I'm not sure which one is leading the pack here. A little bit of column A, a little bit of column B. And I bring this up because policymakers are in a situation where they might make things worse. So before we get to what they're doing, I want to remind you something I quote here on the show many a times because we are talking about inflation. Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. So to put it simply, too many dollars chasing too few products. That's what inflation is. Plain and simple. It's pretty easy when you put it in those words. Now, since policymakers cannot control supply, they have no control over that at all. I mean, unless the government's making something or can try and encourage a business or an industry to make something, they have a little bit of control. But for the most part, what policymakers are in control of is demand. They can increase demand, they can lower demand. That's really what interest rates do. So when you, for example, lower interest rates, you're encouraging people to borrow and consume. So when you raise interest rates, which is everyone is saying, hurry up and raise interest rates to the Fed right now because of inflation. What does that do? It discourages people from borrowing money and it encourages other people to save because, interest rates are higher. I'll put some money in the bank. It'll be worth more. So you're discouraging consumption. That is the goal. And that's also why, people say high prices are the cure to high prices, because high prices discourage consumption, because in some cases you can't, because you can't afford it. In other cases, you're, I don't know if I want to spend that amount. So I'm not going to do that now. I'm not going to buy that product. I'm not going to go on that trip. So it discourages consumption. And the goal is that as people slow their consumption, supply and demand get closer to equilibrium, which means prices will fall. So the last thing our policymakers should be doing right now is encouraging consumption. And yet here we are, and that is what they are doing. According to the Washington Post, quote, the White House and top Democratic lawmakers are beginning to weigh a new push for a federal gas tax holiday, potentially pausing fees at the pump as part of a broader campaign to combat rising prices. Asked about the proposal, the White House signaled that all options are on the table. Really, there should be one option, and that is stop spending and hope the Fed raises interest rates. Because this is the exact opposite of what policymakers should be doing right now. You should not be talking stimulus. You should not be talking a gas tax holiday. You should be encouraging people to slow consumption. Economics 101. But as I mentioned before, I'm not completely ignorant to what's going on. This is politics. And sometimes reality is not something that politicians want to deal with, especially if it's going to be bad. And right now, Democrats are facing really two horrible options. The most likely options, like 99%, are both bad for them. So option one, the Fed is cautious about raising rates, which means prices keep rising and voters go to the polls paying record amount for products. That's not good. That's not good for Democrats. Option two, the Fed raises rates too quickly and it causes a retraction of the economy, which means voters go to the polls during a recession. Also not ideal for Democrats. Because as James Carville famously said, it's the economy, stupid. When people vote, the economy is always the number one issue, and high prices or a recession is not what Democrats want people going to the polls thinking about. So one of the things they can do is to tackle high prices, instead of just letting the market work and let people consume less. Maybe we go into a minor recession, or worst case scenario is prices keep rising and people are just paying more money and can't buy more products, which is going to put them in a negative mood when they go to vote. So what Democrats want to do is just give people more money and subsidize their consumption, which will just exacerbate inflation and make it worse. Now, the Democrats are also, I guess, hoping for the magical third option, which is the belief that eventually supply chains will work out their problems and consumers will shift more spending towards services, which will ease demand on goods. The problem with that is the Fed's been waiting for that to happen for like 6 months. That was the whole argument about the transitory debate, is that they assumed it was a supply chain issue and it was just people's overconsumption of goods. And then eventually people would move back to services, supply chains would get fixed, we would see an ease of demand for goods, and along with supply chain fixes, prices would fall. That hasn't happened. And so that's why prices are going up and up and up. And so the Democrats are praying that that solution comes to fruition. And at some point it will. I mean, at some point the supply chain problems are going to be fixed, but we are in a situation where we're dealing with a pandemic still. We don't know what's going to happen. We don't know what other disruption is going to be caused by this pandemic. And so if that's what you're relying on, that's dangerous. So the Democrats are like, we got to find another way, which is, we'll just subsidize consumption, which is horrible because it's just going to make inflation worse. Because you're just you're putting more money into the economy, which will do what? Increase inflation. Because you're not increasing the supply. You're just increasing the demand, which, as Milton Friedman said, will raise prices. So I get why they're doing it. I get the political side. Others are just stupid and think, we'll subsidize consumption. I think it's also a problem because Washington, we haven't dealt with inflation since the 70s. So it's been so long since they've dealt with it. And for the most part, when it comes to economic disruptions, recessions, they're caused by demand side issues. They have not dealt with supply side problems. And so they don't really know how to react. It's like, oh no, the economy's slowing. Increase demand. No, that's the worst thing you could do. The best thing for all of us is for us to go into a little mini recession. Supply chains get fixed. Everything kind of equalizes. And then we're off to the races. That's what we're hoping for. And that's what will happen if Washington stops being stupid. So it probably will never happen.